So again, thank you for joining me. This is Natalie Pace, and today's video conference is Should You Sell in May and Go Away? So the S&P 500 just hit another all-time high today, May 1st, 2026. And that's kind of interesting, especially in the light of war, very elevated equity prices, very, very high oil prices above $100 a barrel. They're about $102 a barrel right now. Now, the other thing that makes it not as surprising is that this is, in fact, the end of the spring rally. And that's a very well documented period where stocks can increase in value, but it might have a little bit of irrational exuberance associated with it as well. And why do I say that? Well, the stock prices, the only time that they've been higher than they are today is in the dot-com recession. This is a price to earnings ratio analysis. As you well know, in the dot-com recession, things got very lofty and everybody thought it's a new economy and the old rules don't apply. And so everybody was just hanging on to all their dot-com stocks. And then between March of 2000, when the NASDAQ Composite Index soared over 5,000. And October of 2002, when it sank by 78%. Can you imagine if you had $1 million invested, it went down to $220,000. Now, some people will say, oh, but it comes back. Well, first of all, let's just talk about what that is like, right? Being a millionaire and all of the things that you've purchased and all of the interest rates that you've gotten are based on you being very wealthy, or at that time it would have been very wealthy. And then all of a sudden you're only worth $220,000, which might be less than the amount of debt that you owe. That is when things get really dicey, and if you can get in trouble with your bank, the FICO scores in the toilet, and you may even have trouble paying some of your bills, especially if you would purchase like a millionaire and now you're barely a thousandaire, right? So that's problem number one with this whole buy and hold theory. And the second challenge is that it took NASDAQ 15, not, that's 1 5, right? 15 years to hit 5,000 again. So that's too long for you to have your money riding the Wall Street roller coaster. That is too big of a hit to take. So why am I so concerned about high oil prices? Because high oil prices are highly correlated with recessions. If we were to, and I can show you this, it'll take me a second to pull it up, but that's our June retreat if you don't have those dates yet. But here, let's go quickly just so I can show you how highly correlated oil prices are with recessions. And it won't take long at all to get this chart up. Okay, so this is based on the West Texas intermediate price. And what you see here is all of those gray lines are recessions. So why does that happen? Is that well, it's a little under 70% of US GDP is powered by the consumer. And when people can't afford anything because they're spending all of their money at the gas pump, or they can't even afford to drive to the store to get the things that they would like to purchase, then, there's a lot of other industries that really suffer. And believe me, even the oil industry knows this high correlation. So they know that this heyday of them having these very high oil prices, which is going to make their next two earnings reports probably look great, that it's in over the long run, it's actually terrible for them because in recessions, oil prices plunge. They went negative in the pandemic. So the long and the short of it is that that's a well-established trend. And the longer, at this point, like if the war had happened and it was ended quickly and we had high oil prices for a short period of time, that would have been a different scenario. Now that there are mines in the Strait of Hormuz, the war hasn't ended quickly. The longer it drags on, the more it's going to be hard to restart the supply chain because it's not like you just drill for oil and there, boom, you've got gas in your car. You have to refine the oil, and a lot of people don't even realize that over half of each barrel actually goes for plastic and polyester. That's the only upside to this is maybe we'll have less of those two things. Then that leads me to the interest rate question. So a lot of you, if you are hoping that we're going to cut interest rates and you're thinking that's going to boost the economy, which typically happens, um, the pause in the most recent meeting was also met with four dissents. Now, three of those were actually because those governors thought that the language was too nice, that the language implied that if they did take action, it was going to be a pause or a cut, not a rate hike. And they were saying that there is a scenario with the high oil prices becoming more entrenched and inflation becoming more entrenched where they might have to raise interest rates. And so that's what they wanted to do, was to remove the language that indicated the next move was going to be a cut. And the statistics around that are very well established as well. Those of us who are old enough to remember 20%, 20% FOMC federal Fed fund rate back in 1980. And that was because of inflation. So are we going to go from 3.5 to 3.75 to 2%? I mean, 20%. No, but we did go very quickly from 0 to 5.5, right? And that really weighs heavily, not just on the bond market, but also on banks. All right, so that takes me down to elevated equities. We talked about oil, we talked about interest rates, and again, we should say S&P 500 just hit an all-time high. So is that based on the fundamentals? Is that based on too much enthusiasm? Is it based on it being a spring rally? Is it based on people getting some money back from the IRS and wanting to invest it? The retail traders don't have an, a basis of or a foundation of longitudinal experience. And so they have many of them, especially the ones that are under 40, they might not have even seen a recession. We haven't even had much of a correction. I mean, we had a little one in 2022, and that was pretty painful. They did have to endure a crypto winter, but with stocks ringing in all-time highs just on a regular basis in the last 3 years, they may think that everything just always goes up, that everything always comes up roses. So there is a couple of time proven things that aphorisms on Wall Street that I think are appropriate. On the equity side, so investing in stocks and funds, and a lot of the things that you could have in your 401k or your IRA or your RSP, on that side, you want to never confuse a bull market with wisdom. On the safe side, never reach for yield. Those two things are really important because we have elevated equities combined with astronomical debt and leverage. So much so that the US lost their AAA credit rating, right? It first began with S&P Global back in 2011, and now we don't have it from Moody's or Fitch either. So how much should you be selling? Well, I always tell people, first of all, mock up, we have those free web apps, right? You can mock up and personalize your own sample pie chart. You do get a year older every year. It might be that with all of the things I just said, you want to act a little older or overweight a little more safe, so that you don't have it potentially going down by half, or as it did in the NASDAQ, 78%. On the safe side, you're not supposed to lose, not even paper losses. So it's important to know what's safe in today's world. In fact, I've been seeing a lot of headlines about a potential treasury, they're calling it a treasury crisis. And Hank Paulson, who is the former Secretary of the Treasury, former CEO and chairman of Goldman Sachs, he's saying we need to get the plan in place now, so that if it occurs, that we can fix it quickly. So it will get fixed, but it's pretty freaky when it happens, and it also can scare people off, and you don't want that to be happening to you. So I think it's a little bit more than just selling in May and going away. It's making sure you have an age-appropriate, properly diversified plan, maybe overweighting safe, acting a little older than you are. And you must know what's safe in a debt world where treasury bills may have their own little crisis. Now, the other thing that I also wanted to talk about was so if we just go slightly before I get on to the next question, if we go just a little bit deeper, how much should you sell? If you mock up that sample pie chart of what, given the amount you have of liquid holdings, given your age and whether or not you're going to overweight safe, if you have too much at risk in one of 10 slices. So I do think you should have a diversified plan, not everything in large caps, not everything in the Magnificent Seven, not everything in gold, not everything in crypto. And have that diversified plan. If you have something that's really, really did catch on, like the Magnificent Seven, like Peru, like silver and gold, then, you might want to take some profits. And some people might say, oh, well, silver and gold are going to do great if stocks go down. And they do. But in the initial stage, they get drugged down with stocks and then they decouple and then they do well. Copper is known as Dr. Copper because if it is usually the first to drop when the economy weakens. So I think that's it. It's kind of like a stick to your knitting moment where you want to make sure that you have that age appropriate, properly diversified plan. Stocks went up, so maybe you have some gains to capture. And some areas are very low, and maybe you should buy low if you haven't filled up that slice yet, or if it's pulled back. And again, if you are hearing the word paper losses or you're seeing paper losses in the fixed income safe side, then I think you should be considering a second opinion because you've been sold into things that may have more, what they do. There's no reason to have paper loss. Our strategy on the fixed income side has had no paper losses. So there is a plan that you can use. It's not difficult, but it's tricky. And there are many reasons why it's not as popular with financial advisors and broker salesmen. So it's important for you to be the boss of your money and to know what's safe, protected, hot, and diversified, age appropriate, and why you capture gains mentality 1 to 3 times a year. This is all important foundation, like the life math that we all should have received in high school. And then finally, we did get a question that came in. So with sticky inflation, this person wondered if they should invest in tips. And I wanted to show you a chart that kind of tells the story better than any words I could use. So if we just put in here, I believe that there's a Schwab tips one too. There's that one that's the iShares. Let's see what the Schwab tips ETF is, because I want to show you that one as well. So you know that it's not a one-off. Oh, SCHP. Okay, so this is the Schwab tips. And as you can see here, it did really well in 2021. And then at the beginning of 2022, it just dived. And that was the case as well with TIP, which is the iShares one. Let's go ahead and put that one in too so you can see it. I can tell you the reasons why that is the case. Same scenario. So what we actually saw, especially in the TIPS funds, were that it was really a bad idea. And why is that? Because high inflation typically means that the feds are going to have to raise interest rates. And so when you raise interest rates, the value of whatever bond you have goes down. So even though you're thinking, oh, with inflation, I'm going to do great, it's not the case because the interest rate got raised. If the rates get cut, then it could work out. But that rate cuts are not associated with inflation. So there was one exception to that rule. And it does have a lot of fine print that you have to read, and you can't invest very much in it. And that was the Treasury inflation-linked savings bond. I think you were limited to $10,000. And in 2021, 2022, somewhere in that range, it was offering almost 10% for 6 months. The next time it came around and it was cut down to like 6.7%. And here we are in 2026 and it's now closer to 2%. So you have to hold it for a certain period of time. They want you to hold it for 30 years. If you don't hold it for 30 years, you're going to lose 3 months of interest. But if it goes below the market, that's worth losing. So I'll show you what that one is. This one, but this is different because I mean, the value of it would go down a little bit if you were trying to sell it, but you actually just end up really selling it back to the government. So it's called the Treasury Inflation Linked Savings Bond. I think that's it, the I bond. And again, right now it's at 4.2%, 6%, but it will reset again in 6 months. So it looks like it just got this one in there, and you're going to get a new reset on November 1st. So yeah, so it's a combination of the Fed fund rate and the inflation rate. And that could work out, but it's smaller and it's one thing and it's not a fund. And it's not certainly anything that you can build a $1 million portfolio on because it's only $10,000. So I hope that's helpful. And again, if any of these things you have any questions about, you can always email info@nataliepace.com. One last thing I do want to say is that the Treasury bill situation has made us prefer highly rated short-term corporate bonds. And you're earning, pretty much the same yield with very, very, it's very unlikely that you're going to have that credit crisis problem that they've been talking about with Hank Paulson. So I am going to be doing a blog on that, kind of comparing, AAA or AA plus corporate bonds to US Treasury bills. And another tip is our mantra for the safe side is keep the term short, keep the credit worthiness high, and don't put all of your eggs in any one asset, and have rolling maturities, but not duration. Like duration should be short, but rolling maturities so you have access to your money, and then always know how long you can not have access to your money. So can you go out 2 years and you won't need it in case there's any fluctuation in value? Okay, I'll stop it here just in case anybody has a quick question, and then I'll come back and close out. Okay, so it was a good question. And it was like, okay, so should we go back into that Treasury I inflation linked bond, which is an actual bond, and you can, so you're going to probably be able to sell it at par when you sell it and all of that. And I'm still not convinced that you should. And the main reason is you're not getting paid a lot more. And I also just said that there's a lot of noise from the economists and financial experts that, for a multitude of reasons, including our debt and becoming less popular and more isolated in the world, that our treasury bills could have their own little mini crisis. And again, I am going to be writing a blog about that coming up in the next week. Does it mean that your treasury bills will be worthless? No, no, no. It's not going to be anything like that. But again, even with T-bills, we're saying keep the term short and the credit worthiness high. And here you're going to have a T-bill that they want you to hold for 30 years. So I'm not that comfortable with it, mainly because of the asset itself, and also that you're not earning a lot more right now. It's only about 4.25%. So it's not that much more than if you loaned that money to Microsoft, which I would have a greater level of confidence in. So I would say, I guess, no, I'm not saying that. All right, so I already told you guys about the June retreat, and I do hope you'll join us. That is online. So we're going to have the Financial Freedom Retreat on June 5th through the 7th. You can attend in your pajamas from anywhere in the world. And after that, the Saturday after that, we're going to have our Preparing for Retirement, starting with your first job. That's going to be a new masterclass that I've never taught before, but I think it's going to be pretty popular, and you should check out the things that we're going to be focusing on. And then the day after that, on Sunday, June 14th, I'm actually going to host the Financial Freedom Game on the beach here in Santa Monica. We've been able to do that when I've been in Santa Monica. I don't do all of the training online in a boardroom because if you're going to come to Santa Monica, why not enjoy the outdoor and the setting and the beach and all that? But I am encouraging you to come and join us. It's going to be at 4 o'clock in Santa Monica Beach. It takes about an hour and a half or 2 hours. The sun is kind of setting again. We still have a lot of sunlight, so it's going to be just a softer sun, but still should be bright out. Of course, you should take whatever kind of sun protection that you believe in. But do email or call 310-430-2397 or email info@nataliepace.com if you'd like to join us for the online retreat, or if you might be interested in that financial freedom game on the beach. And of course, for those of you that are still interested in the Restoremal retreat, we now only have 3 rooms still available. And this is kind of like an adventure of a lifetime. It's pretty special. I will say that of the people who have registered, more than half attended in 2023 and are coming back. And I think that does tell you a little bit about how popular it is and how much people really enjoyed their time there. So you can learn more at Restoremal Retreat flyer, or you can email info@nataliepace.com. And then, of course, remember to follow me on social media so that you don't miss. I mean, I think that Treasury bill versus corporate bond thing is going to be a big one. But here's all my social media, and that's where I do daily money tips, as well as make sure that you're aware when a new blog is posted or a new video conference is up. So thank you again. It's Natalie Pace on YouTube, Natalie Pace on Substack, info@nataliepace.com if you would like to reach out to us. Thanks. Fools are making history.